To fully grasp the magnitude of what may be unfolding, we need to zoom out even further, beyond quarterly data, beyond annual deficits, beyond even this cycle of monetary tightening, and examine silver through the lens of long monetary history. For most of recorded civilization, silver was not a speculative asset. It was money. Empires rose on silver standards. Trade routes expanded because silver functioned as a universally recognized store of value. The Spanish Empire's extraction of New World silver reshaped global commerce. The bimetallic standards of Europe and the United States anchored currencies to tangible metal for centuries. Silver's demonetization in the late 19th and mid-20th centuries did not erase its monetary memory. It merely shifted its official status. When the United States removed silver from circulating coinage in 1965, it was not because silver had lost value. It was because silver's market value was rising relative to its fixed coinage value. Monetary authorities could not maintain parity without draining reserves. That detail matters. Silver was removed from money because it was too valuable to remain money at an artificially suppressed price. History does not repeat precisely. But it rhymes. Today, silver is not poised to return as circulating coinage. That is not the thesis. The thesis is subtler, that silver's monetary identity, long overshadowed by gold, is being quietly rediscovered in an era where fiat credibility is incrementally questioned. Rediscovery does not require legislation. It requires preference. When individuals choose to hold physical metal outside the banking system, they are making a monetary decision. When central banks classify a metal as strategic, they are making a monetary acknowledgement. When banking systems permit silver as collateral, they are embedding it into monetary architecture. These are not symbolic acts. They are structural signals. The modern financial system is built on confidence in abstraction, digits on screens, sovereign guarantees, derivative contracts. That abstraction works extraordinarily well during stability. It strains during uncertainty. The more complex the system becomes, the more nodes of potential failure exist. Complexity demands trust. Silver's appeal increases when trust decreases. This is not a moral argument. It is behavioral finance. During periods of expanding trust, investors seek yield. During periods of eroding trust, investors seek resilience. Resilience is not measured in percentage returns alone. It is measured in independence from counterparties. Now consider demographic and technological shifts. Digital finance has accelerated transaction speed and increased systemic interconnectedness. While this efficiency enhances liquidity, it also increases systemic coupling. A disruption in one segment can cascade quickly. Physical assets, by contrast, are not instantly coupled to global networks. Their valuation may fluctuate, but their existence is not dependent on digital clearance. This distinction grows more relevant in a world increasingly reliant on interconnected systems. Add to this the political dimension. Public trust in institutions across many advanced economies has declined over the past decade. Political polarization, fiscal expansion, and crisis management fatigue all contribute to skepticism. When skepticism becomes cultural rather than episodic, allocation behavior changes generationally. Younger investors who witnessed bank failures, emergency monetary interventions, and currency volatility during formative years may carry different risk assumptions than prior generations raised in disinflationary stability. Risk assumption drives asset allocation. Silver's accessibility relative to gold makes it a natural entry point for those seeking tangible hedges without institutional gatekeeping. But accessibility also introduces volatility. Silver's market capitalization is significantly smaller than gold's. That smaller size makes it more sensitive to capital flows in both directions. This sensitivity amplifies moves and contributes to its reputation for unpredictability. Yet sensitivity is also leverage. In monetary transitions, smaller markets adjust faster once flows turn decisively. We must also address the perception problem. Silver has long been associated with fringe narratives of imminent collapse. That association has damaged its credibility among mainstream investors. But reputational inertia can mask structural change. Gold once faced similar skepticism before its early 2000s repricing gained institutional acceptance. Perception lags reality. If silver's silent repricing continues, if floors continue rising, if deficits persist, if sovereign classifications harden, perception will eventually adjust. And when perception shifts, allocation models follow. Allocation models drive large capital pools. Large capital pools move markets. The silent phase precedes the allocation phase. One of the most telling indicators to watch is not price alone, but narrative shift within institutional research. When silver transitions from being described as volatile commodity to a strategic monetary asset with industrial leverage, the repricing will be well advanced. Language change precedes capital change. We are beginning to see early hints of that linguistic adjustment. But the transition remains incomplete. And that incompleteness is precisely why this moment matters. Because once consensus forms, opportunity narrows. The silent repricing thesis does not require apocalyptic outcomes. It requires incremental recognition that silver occupies a unique position in a world confronting fiscal excess, geopolitical fragmentation, and technological transformation simultaneously. It is not purely defensive like gold. It is not purely cyclical like copper. It straddles both worlds. Assets that straddle categories often surprise during regime shifts because they do not fit neatly into existing models. Silver may be in the process of redefining how those models treat it. Not loudly. Not dramatically. But persistently. And persistence, in markets, is often the most powerful force of all. If persistence is the defining characteristic of silent repricing, then the final layer to examine is timing, not in the sense of predicting a specific date, but in understanding the conditions under which gradual adjustment becomes visible acceleration. Every structural repricing reaches an inflection point. That inflection point is rarely triggered by a single event. More often, it emerges when multiple slow-burn pressures converge within a compressed timeframe. A policy miscalculation. A liquidity squeeze. A geopolitical escalation. A delivery disruption. Individually manageable. Collectively catalytic. Silver does not need a crisis to reprice. But a crisis can compress years of gradual adjustment into months. Consider sovereign debt markets once more. If bond markets begin demanding higher yields to absorb expanding issuance, central banks face a dilemma: allow yields to rise and risk fiscal instability, or intervene and risk currency dilution. Either path reinforces hard asset allocation logic. Now layer in potential supply disruptions. Mining is geographically concentrated. Political shifts, labor disputes, environmental regulation changes, or energy shortages in key producing regions can temporarily restrict output. In a balanced market, such disruptions are absorbed. In a deficit market, they amplify stress. Amplified stress accelerates repricing. There is also the possibility of a confidence event within derivatives markets. Not necessarily a default, even a temporary settlement irregularity or abrupt rule adjustment can alter participant behavior. When rules change mid-cycle, trust recalibrates. Trust recalibration increases demand for certainty. Certainty commands premium. Premium widens spreads between physical and synthetic pricing. Widened spreads attract arbitrage until arbitrage capacity is exhausted. Exhausted arbitrage exposes structural tightness. But timing cannot be forced. Many investors attempt to anticipate inflection by positioning aggressively ahead of confirmation. Sometimes they are rewarded. Often they endure extended consolidation before the thesis matures. Silent repricing rewards patience more than leverage. The temptation to overextend during early phases can undermine otherwise sound positioning. This is why understanding structure matters more than forecasting daily moves. If valuation floors are migrating higher due to structural forces, temporary volatility becomes noise rather than thesis invalidation. Now consider a different angle: global liquidity cycles. Liquidity expansion often begins quietly. Central banks may ease policy incrementally before acknowledging a broader shift. Liquidity, once reintroduced into the system, seeks assets with asymmetric upside potential. Silver's relatively small market size makes it sensitive to liquidity waves. When liquidity aligns with structural deficit, repricing can accelerate dramatically. We have seen versions of this dynamic in past cycles, rapid upward moves following extended dormancy. But here is the distinction: prior accelerations often lacked today's strategic overlay. Today, silver is not merely a trade. It is embedded within energy policy, technology infrastructure, and strategic mineral classification frameworks. That embedding reduces the probability of sharp mean reversion following spikes, because baseline demand remains intact. Another dimension worth considering is intermarket signaling. If gold continues firming despite elevated yields, it suggests monetary hedging demand outweighs opportunity cost. If copper strengthens alongside silver, it signals industrial expansion. When both monetary and industrial proxies move in tandem, silver's dual identity activates. Dual activation is rare. When it occurs, correlation matrices shift. Shifting correlations disrupt algorithmic trading strategies anchored to historical relationships. Strategy disruption can create volatility. Volatility attracts discretionary capital. Discretionary capital can amplify trend. The silent phase transitions into recognition. Recognition transitions into participation. Participation transitions into momentum. But even momentum, if grounded in structural fundamentals, need not be unstable. It can represent equilibrium finding a new level. We must also examine risk. What could invalidate the silent repricing thesis? A credible, sustained return to fiscal discipline across major economies would reduce monetary hedging demand. A technological breakthrough dramatically reducing silver intensity in industrial applications could soften structural deficits. A coordinated geopolitical détente restoring reserve confidence could temper sovereign diversification. Each of these outcomes is possible. But each requires synchronized policy and innovation success across multiple regions. The silent repricing thesis, by contrast, requires only continuation of current trajectories. Continuation is statistically more probable than coordinated reversal. Markets operate on probability, not certainty. As probabilities shift, so do allocations. Silver's allocation shift may still be in early stages. Evidence suggests that long-term holders are accumulating quietly while speculative participation oscillates. That pattern often precedes durable trend formation. Durable trends rarely begin with fireworks. They begin with recalibration. If you step back and view the broader arc: deficits persisting, sovereign classification evolving, industrial demand anchored, fiscal stress unresolved, trust fragmenting, silver's current price behavior appears less like anomaly and more like adjustment. Adjustment is not exciting until it compounds. And compounding, once visible, is often mistaken for suddenness. The monetary shock already underway may not resemble a crash or a spike. It may resemble a slow realization that silver's baseline value has shifted higher, not because of hype, but because of convergence. Convergence of debt expansion. Convergence of strategic policy. Convergence of industrial indispensability. Convergence of ownership preference. When convergence matures, markets do not ask for permission to reprice. They simply do. And by the time consensus forms around the narrative, the silent phase is long over. The question is not whether silver will move tomorrow. The question is whether the structural forces shaping the global economy are pointing toward greater reliance on tangible assets over time. If they are, then silver's silent repricing is not speculative imagination. It is monetary evolution unfolding in real time.